Let's start with retirement savings, because there was some mention of taxation of retirement savings coming through in the budget last month. And my question would be, is this going to affect RAs? Because many people invest in RAs because of the tax implications of a retirement annuity.
Good morning and thank you. Yeah, the retirement adaptation, the tax adaptation in retirement funding has really been that the regulator and revenue have capped the tax deductible contributions of individuals. I think that the rationale behind that is above a figure of 200,000 rands saved into a retirement annuity on an annual basis. You're probably not going to be a basket case at retirement. You're probably not going to be a ward of the state. And therefore the state doesn't need necessarily to give massive tax breaks to people that are saving greater amounts than that. It was uncapped historically.
So do RAs still have the attraction that they had before then?
Very much so, because the simple analogy in our estimation is that you get a deduction of the contribution to RAs within certain parameters, but you get a deduction against taxable income. So effectively, if you were to save in a discretionary unit trust, let's argue, or you went into the same unit trust but through an RA, you'd have a 40% saving on your contribution. Then in the RA fund, you have no tax profile inside the fund whatsoever, either on capital gains or income tax or rentals on a property portfolio, should that be your choice of underlying investment. And then on retirement, the counter argument is that you would pay tax on that which you drew out of that portfolio. But if you have a decent advisor and a decent tax person looking after you, you can manage that across your own income, that of your wife, perhaps your trust, and in so doing mitigate the tax profile. The other big advantage is that the retirement assets do not form part of your personal estate. So from the point of view of a business risk management point of view during your working life and post-retirement, your physical estate after death, this is quite material, because there's going to be no CGT applied at death, and there's going to be no estate duty applied at death. It goes to your beneficiaries with bypasses that estate trap, which is at the moment 10% capital gains tax on gains made, and then a further 20% on your estate.
Private equity, back in the headlines over the past month, we had Brait making some changes to its approach to private equity. It's going to be raising some money from the equity markets to fund deals going forward. Are we seeing renewed interest in private equity now that the recession is behind us, now that the economy is growing again?
It's a very interesting global theme, Stephen. Private equity is not for the faint-hearted. And yet, having said that, the returns out of the major funds, Mutual have a fund, Momentum, I know, have a fund, and then you have the Braits and the Ethoses who have their own clients, and obviously a slightly changed agenda of late, but they've been very effective in that marketplace. They've bought businesses typically unlisted with an exit strategy which is much longer term than a short-term investment into, say, a unit trust, which again in itself should be a long-term play. But because of the way that they've been managed, because of the marketing, because of the reporting, short-term reporting periods and the pressure there, people have kind of jobbed them more aggressively. Private equity is not that. It's probably has a 7 to 10 year timeline, but the returns have been very interesting. On a global level, you're finding big guys, and very often we find that CalPERS, the Californian sort of pension authority, used as a if they're doing it, then it's okay, into hedge funds or into private equity and or alternative investments or whatever, and they are investing in this sort of asset, and there are some very interesting returns available, but it's deep pocket, long timelines, and I think investors will be rewarded.
And not for the faint-hearted, as you said.
Yeah.
We've been chatting about inflation and interest rates today, and this is something we've broached before when you've come into the studio. With inflation starting to turn, expected to spike this year perhaps, how do you hedge against that inflation, particularly if you are nearing retirement?
Well, I think that the retirement space has got a couple of connotations to it. The first side of, and the traditional side of advisory businesses and planning was you take risk off the table, you take money out of the marketplace. Well, that's counterbalanced by a significant development over the last couple of decades where people are living a whole lot longer because of advances in healthcare, better sanitation, all sorts of reasons, just on a global level. In South Africa, we're not in any way excluded from that. Although there's high mortality in certain parts of the community, longevity is becoming the name of the game in planning. So it's almost counterintuitive to me to take all your funds and put it in the bank, especially if you're in a low interest rate with tax risk environment. So how then do you mitigate that risk but stay in the game, so to speak? We've been a big player, a big promoter of property rental, property growth type strategies. And there you can have the listeds, which have done phenomenally through the last 10 years. It's been a remarkable period. I think it could have run ahead of itself. It hung in when the rest of the market got walloped. And the reason for that probably is that the market got walloped with low interest rates, whilst interest rates were low and lowering. Therefore, the rental streams would be very attractive. The gains have been substantial in the listed space. They've come off in Q1 2011, but they remain reasonably attractive. Vacancies are at 5 or 6%. But the opportunity there is that you have a lease linked to inflation, a lease with an escalation. So your income stream is linked to inflationary pressures. Capital values will move as rentals increase. So that's a good story as a fundamental way of managing the need for escalating income without taking full market exposure and full market risk.
And do you think listed property will continue to deliver inflation-beating returns like it did last year? I think it grew by 20 to 30% last year.
It was mid-20s. Some of the funds were ahead of and below that, but mid-20s. That was remarkable. If you think that inflation was in the sort of 3, 5, 7, whatever, depending on your standards and your measurement, your criteria of measuring inflation, but it romped ahead of it. It's paid a little bit of a price there because what properties do is that they act very similarly to bonds. They kind of an inverse play on interest rates. If interest rates drop, the value of bonds goes up and the value of properties typically goes up. If interest rates go up, the opposite occurs. So there is a bit of a caveat there. Just be careful because interest rates probably are going to trend upward as inflation resurfaces and becomes implicit in the system. And there could be some short-term profit taking. But as a long-term strategy, it is again a long-term strategy. It forms an important part of an asset class blend into a sensible portfolio.